We are beginning this hour, though, with the market moves, a sell-off on Wall Street with stocks extending their losses from last week. The Fed firmly in focus. We're going to get to Brian Chung on that FOMC meeting in just a bit. But let's kick things off with Jared Blickery on the moves we're seeing so far in the session today. Jared.
That's right, Akiko. What another start to another week, the fourth one this year. And let's take a look at the Wi-Fi Interactive. I've been charting the price action on a year-to-date basis. Here's the Dow, and you can see just really falling off of a cliff here. The loss is really accelerating to the downside over the last few days. There are some technical reasons for this, but sometimes selling just begets more selling, and any attempt to buy the dip has just been met with a lot of force in the other direction. Now, also want to show the small caps. This is the Russell 2000. I'm going to put a one-year chart on, and we are on bear market watch for the Russell 2000. We already reached the magic level earlier today. I think it's 1951 and change, but it would take a close at that level or below to officially generate those headlines. And then let's take a look at the VIX, because we're seeing some of the highest levels that we've seen in months here. Now, we took out that November, December spike here, and we are back to the levels seen not seen until last March. So really picking up on the fear index as well. Then you take a look at what's happening in the bond market. We have the 10-year, the 5-year T-note yield cooling off a little bit. This is a 2-month chart. It is down 3 basis points today, continuing the down move from last week. And then the 10-year T-note, that is down 2 basis points as well. And finally, we got to take a look at the US dollar before we get to our heat maps. That is crawling back into the territory that we saw back in early January and also in December. Let me put a 3-month chart here. I think this is important. Dollar had been basing sideways, then it broke down, and it looks like this was a false breakdown because we are right back up. So pretty interesting to chart that here. Now, as promised, here's the Nasdaq 100, and it is an ugly picture. We got Tesla down 6%, Microsoft and Alphabet each down more than 3%, Nvidia getting hit 6.5% down. And you take a look at the sector action, nothing in the green today yet again. Tech taking it on the chin, actually just switching places with materials as the worst off sectors, and that is as the US dollar is rising, putting pressure on commodities. Also seeing healthcare down over 2%, so is consumer discretionary, financials, energy, and the list goes on.
All right, David Nicholas joins us this morning right before the market opens. All right, David, what are you telling your clients to do right now?
Well, Stuart, we're telling them, obviously, the volatility is not over. We are telling them, look, if you're looking to buy, don't use all of your dry powder in one day. So we think that the next few weeks could really be some, if you look at where the VIX is today, volatility is not going away. So there's going to be buying opportunities. We bought a little bit on Friday. We bought a little bit yesterday. Still have about 10% dry powder. We will be buying on dips. So the worst thing I can tell you, we had clients calling in yesterday saying, David, please sell. I want to get out of the market. And we pleaded with our clients and look, we'll do it, but we don't advise selling in these large down days like this because, we did see that big turnaround yesterday, but these are the times you want to be buying. As painful as it is, as hard as it is, you've got to buy because you've got to remember, we're owning companies today that we want to be owning 5 or 10 years from now. Okay. So these are the moments we want to be buying.
All right, a specific question on the situation in Ukraine and Russia and America. What happens to the stock market if Russia does invade Ukraine?
Yeah, geopolitical risk is the risk that we would put into our systematic or black swan risk. Certainly, that's going to put pressure on the market, Stuart. But here's where I would draw the line. If U.S. troops stay out of combat with Russia, and they will, the markets can absorb this, and we'll be okay. If there's any altercation with U.S. troops, it's going to spell trouble.
Okay, understood. But the Russians walk across the Ukrainian border, they invade. Does the market immediately sell off big time? I mean, big time.
No question. I mean, you'll see a 10 to 12% pullback, I think, in a situation where Russia invades. And we got to be prepared for that, right? And we could see that. So investors have to understand that geopolitical risk is a risk on top of the Feds, on top of interest rates, that is now added to this market. So we got to be vigilant.
What do you make of the Microsoft earnings report that's coming out this afternoon? I mean, if they disappoint, this whole market looks really shaky, doesn't it?
Excellent point. So if I can correlate it to IBM, we saw IBM report yesterday, really good earnings. What happens to IBM? Look at the stock this morning, we're up. I think Microsoft will follow that, Stuart. So if Microsoft reports well, I think that'll provide some support for the market. If Microsoft fails and cannot give us good earnings on their software, on their top line growth, It's not good. And I think we're going to continue to see selling pressure in tech. So goes Microsoft today. So goes the rest of the tech market for the week.
But you would not tell any of your clients to sell today, or you didn't tell them to sell yesterday. It's like that thing, don't try to catch a falling knife. Is that it?
If I can give you the Warren Buffett quote, what Warren Buffett says, Stuart, if you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So our clients know money in the market today is money we're using 10 years from now. The money I need this year for my expenses, for my retirement, that's coming from other sources out of the market. So we're buying. We are not sellers in this market.
Okay.
I cannot reiterate that, Stuart.
Okay, Dave.
Learn something about the current meltdown by looking at the decline in Bitcoin from April to June of last year. Okay, this collapse was as severe as the 1929 stock market crash. We're talking something losing more than half of its value in a matter of 8 to 10 weeks. Sometimes this kind of breakdown can cause structural damage to a given market, resulting in a labored recovery that might not erase more than 50 to 60% of the losses before the decline resumes all over again. However, Bitcoin was the exception. It quickly rebounded off its lows from last summer and snapped right back, hitting a new all-time high in the fall. Will you look at that? Nice comeback. After that extended rally, though, DeMarc's model turned negative again, this time in November. Another trend exhaustion top. Since then, we have seen a hideous meltdown in all things crypto. At this point, the latest Bitcoin sell-off is almost as bad as what we saw last spring. It's down roughly 50% over 50 trading days. Once again, DeMarc says there's a possibility of long-term structural damage to the whole crypto space, which could translate into a feeble rebound whenever this thing stops going down. But DeMarc's betting that won't happen. Let's zoom in on the 7-day chart of Bitcoin. Remember, DeMarc has a 13-session countdown pattern that tells him when a rally or a decline is likely to exhaust itself. Right now, Bitcoin's currently at 11. Okay, this sell-off is 11 on the buy countdown. We need 2 more negative closes before his buy trigger fires. Now, DeMarc also wants to see Bitcoin testing his downside price targets. It briefly broke down below his higher target at 34,495 earlier today, before rebounding off its lows. However, if this rally proves to be short-lived, then DeMarc wouldn't be surprised to see Bitcoin getting hit with a 2 or 3 day panic selling climax, which could take it all the way down to 26,355. Who wouldn't want to buy it there? To put this in historical perspective, during the last big meltdown from April of last year to late June, Bitcoin lost nearly 56% of its value. Take a look at this comparative chart. If we get a similar percentage size decline from this November highs here, then you'd expect Bitcoin to bottom at around 30,557. DeMarc also notes that Bitcoin's angle of descent last April, got that? The degree of the decline is identical to its current angle of descent. In other words, there's a good chance that history continues to repeat itself.